every Monday to Friday. This is Peter Lewis's Money Talk.
Money Talk.
Good morning and a warm welcome to Money Talk for a brand new week. It's Monday the 26th of June. This is Peter Lewis, and let me thank you for making this podcast one of the most listened to financial podcasts in Hong Kong. This podcast is sponsored by Surfin Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, an important gauge of Japan's consumer prices rose at its fastest pace in 42 years in May, providing a test for the Bank of Japan as inflation proved stickier than expected. The so-called core consumer price index, which strips out energy and food prices, but includes alcoholic beverages, rose at a higher than expected annual rate of 4.3%. That's the fastest year-on-year increase since June 1981. The Eurozone economy has slowed sharply in recent weeks, according to a closely watched business survey that indicated a period of recent growth in the services sector is stalling. The flash Eurozone Composite Purchasing Managers Index, which is a measure of activity in manufacturing and services, fell to 50.3, the weakest reading since January. A 3-day state visit to the US by Indian Prime Minister Narendra Modi came to an end Friday with a meeting with tech company leaders as the Biden administration aims to diversify supply chains away from China. The guests at a state banquet that President Biden hosted for Mr. Modi included Sundar Pichai, the Indian-born chief executive of Google, and Tim Cook, the CEO of Apple. And following the event, Apple's Tim Cook described India as a huge opportunity. Global stocks fell on Friday, capping their worst week since March, as investors in the US and Europe fretted over the prospect of further interest rate increases and a potential recession. The FTSE All-World Index, which tracks the largest companies globally, slid 1%, bringing its weekly fall to 2.2%, its worst performance since the US regional banking crisis began in March with the collapse of Silicon Valley Bank. On today's programme, I'm joined by Alex Wong, Director at Alex K.Y. Wong Asset Management, and Hong Kong-based macro strategist Patrick Bennett. With a view from mainland China is Yanan Wu, the Chairman and CEO of Surfin Group. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street Friday, all three major indices posted losses for the week, ending 8 straight weeks of gains for the Nasdaq and a 5-week streak of gains for the S&P 500, as investors pointed to economic data that showed the global economy is cooling. Several central banks raised interest rates last week, and Fed Chairman Jerome Powell told lawmakers that the central bank's inflation-fighting campaign isn't over. The S&P 500 suffered its worst week since March, sliding 0.8% to 4,348, taking its losses for the week to 1.4%. The Dow fell 219 points, or 0.7%, to 33,727, ending a 3-week positive run with a loss of 1.7%. The Nasdaq Composite closed lower by 1.1% to end at 13,493. It dropped 1.4% over the week. And the CBOE Volatility Index, the VIX, fell to 13.44. That's the lowest since January 2020. US Treasuries rallied following the woeful EU PMI data, which flagged recessionary concerns. The yield on the benchmark 10-year note fell 6 basis points to 3.74%, and the yield curve between 2-year and 10-year Treasuries inverted to minus 101 basis points last week. The US dollar index rallied strongly on the week, notching its second best week since February with a gain of 0.6%. The Japanese yen hit a fresh year-to-date low of 143.68 against the dollar, a loss of 1.3% over the week. And crude oil prices saw heavy weekly losses. Brent crude oil fell 0.4% Friday to $73.85 a barrel. For the week, it's down 3.6%, its biggest weekly drop since early May. Hong Kong's Hang Seng Index slid 1.7% Friday, leading losses in the region. The index closed 328 points lower at 18,890. For the week, it was down 5.7%, the biggest weekly loss in 3 months. The tech index sank 2.1% for the day and 8.4% for the week. Futures markets are pointing to a lower start for the Hang Seng this morning, with a loss of around 140 points. That's 0.7%. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our Monday morning guests. We have with us Alex Wong, Director at Alex KY Wong Asset Management. Morning to you, Alex.
Good morning, Peter.
And also joining us, Hong Kong-based macro strategist Patrick Bennett. Morning, Patrick.
Good morning, Peter.
Well, as we have two market experts with us this morning, let's talk markets for the rest of this morning. The global picture first. As you heard there, the FTSE All-World Index slid 1%. That brings its weekly fall now to 2.2%, its worst performance since the US regional banking crisis. Alex and Patrick, this week it's the end of the first half, so presumably we're going to start seeing some portfolio rotation as funds position now for the second half of the year. What should investors be looking at as we move into the second half?
Well, look, I think it's the first half has obviously been very difficult. I think the main or one of the key things that investors have not grasped particularly well is the notion that interest rates globally are going up, have gone up, and are likely to continue to remain high. And so this looking for defensive positions, I think will continue. And I say defensive, perhaps into utilities as people start to spend less because they have less disposable income, and I think that will be a theme which develops more in the second half of the year.
The bond markets seem to be getting to grips with that notion now, don't they? Because at the beginning of the year, they were pricing in rate cuts at the end of this year. But the bond markets, maybe bond investors are coming to terms with this. But do you think equity investors are?
I think the bond market is getting to grips with it. The inversion is probably still quite extreme, at these levels, although not looking likely to reverse anytime soon. Yeah, I don't think the equity investors have got quite to grips with the higher interest rate environment and the fact that it's going to be sustainable.
For me, I think in the first half, the major theme of the equity markets is the rise of AI. So we are seeing a renewed interest in the growth sectors, especially those mega techs. So I think we probably may still see this theme to play out, but sectors may not benefit from the rise of AI. Actually, I think would be under pressure because the fear of sustained high interest rate environment and also recessions actually would pressure those stocks. So we probably will continue to see polarized market performance, and also we probably may see very narrow-based strength in the markets.
So are you saying that's this second quarter rally that we've seen in AI, can this continue much further?
I think it would continue. Actually, I think a few counters actually may still outperform. So at least they probably would be more resilient than others. So we probably may still see strength in several counters and probably supporting the US index, and that probably would outperform other markets.
Well, if we look at the US markets, do you worry now about the valuations? I mean, if you look at the S&P 500, it's trading now 19 times forward 12-month earnings. That's quite a way above average. The NASDAQ 100, which is a third this year, that's trading at 27 times now forward earnings. Is this getting to extreme levels where we ought to be prepared at some point in the second half for a big drawdown? I
think we may see some drawdown, especially in several sectors. But overall market, I think may not be too bad because, as I've said, probably mega techs would still be supported. And probably people will not care about too much on the short-term earnings on those mega techs because people probably would like the sector dominance of those companies. So I think we probably would still see overpriced mega techs. But other sectors actually may correct, I think, because they probably will not benefit too much in the new era, and also the high interest rate environment would be sticky. So I think we may see devaluation of the old economy sectors in the US.
Patrick, do you worry about these valuations in the US?
Look, I think they are quite steep or quite rich at these levels. I think that's due to the fact that despite interest rates having gone up, there has been to date still quite a bit of liquidity in the global economy. A lot of people's mortgages are being reset, perhaps this year, haven't been yet. Although they appreciate that interest rates have gone higher. So I do fear that with this withdrawal of liquidity, which is going to continue with less disposable income, that validating these prices, I think, is going to become more difficult. I don't have a fear the market overall. I think that we will continue to be perhaps flat to slightly weaker. I don't think we're at risk of a precipitous decline, because I do believe that central banks, even though they are determined to beat inflation conclusively, their bottom line remedy, is not to raise rates to such extreme levels, if indeed we were to head into a precipitous decline.
And do you think this AI rally can continue?
Well, I think it's a new kid on the block. People who are rotating out of other sectors that they haven't had the same success in of lately. I think that there's still an amount of momentum in the sector, which means it probably does okay.
Alex, what could cloud the outlook here, sort of going forward? We saw those flash PMIs from the Eurozone, which were pretty bad, weren't they? They suggest that the Eurozone economy, not only is it suffering from high and higher interest rates, it could almost be in recession by now.
Oh, yeah, I think probably people are expecting recessions. Actually, we have been talking about recessions for probably a long time, yeah. So we are finally seeing this, and probably recessions would mean peak interest rate as well. So I think people have priced in a lot, and so the correction pressure may not be too much. And I think probably some markets would underperform a lot because of the lack of participation in the new AI era. And do you think that actually we could end up with stagflation in some places, where actually not only does these interest rate rises push the economies into recession, but actually inflation, it seems to be remaining quite sticky, doesn't it? Core inflation anyway. Yeah, but I think probably we may see China to export deflation later on. So the risk of a very long stagflation scenario may not be in place, I think, because probably we have already seen commodity prices coming down, and China actually is pretty weak in its performance, and probably it will ease the global inflationary pressure.
Patrick, do you worry about stagflation? Is this a risk?
Look, I think it's a risk on a sort of 1 or 2 quarter basis, but I would agree with Alex. I don't think it's going to be sustained. Sort of back to a point earlier, I think that global central banks now, if we look back at previous episodes of stagflation, historical episodes, then we didn't have the same activism, perhaps, if that's the right word, of central banks. So I believe that they wouldn't let that situation. They wouldn't let that situation persist.
What do you make of the Bank for International Settlements, what they said over the weekend in their annual report? I mean, they were basically saying that fiscal policy also needs to step up to the plate. In other words, government should be raising taxes, they should be cutting back on spending, so that all the work isn't just done by interest rates. What do you make of that?
Yeah, well, look, they never really come out and give the morally fantastic story for what these governments should do. I more take the view that I think when the private sector stops spending, and when they will stop or slow spending because of high interest rates, it's incumbent on the public sector to actually to provide some support. I do believe that fiscal and monetary policy should work in greater tandem, but I'm not convinced that they should be out there now, withdrawing support, at this stage.
What do you make of it, Alex? They were basically saying that, all this stimulus that we've had, it just basically allows for reckless borrowing by private companies, and now there's a huge amount of debt that's got to be unwound.
I think, but I don't think the government will withdraw. I think the reality is that I think they will continue that kind of fiscal policy. So I don't think that would happen. So there's no more to discuss, I think. Yeah.
But some of this debt is in, you've mentioned this before, Alex, commercial real estates, that could be a problem for the second half, because that's where there is a lot of debt, isn't there? And a change in the way in which people are working means there's not that demand anymore. Is this going to be a growing concern in the second half? Yeah,
that will be a growing concern, because I think this sector basically is gone, I think. Then the prices actually have to correct, and probably we may see those borrowers are in trouble. So I think that is a point of concern. So probably may drag down other things as well.
Patrick, what do you make of the China markets? If we look at the mainland and here in Hong Kong, despite the policy easing that we've seen on the mainland with the cuts now in all the major benchmark interest rates from the People's Bank of China, the market just hasn't been able to put up any sort of sustained rally year to date, has it? And it's the global underperformer.
Look, that's right. We've spoken about it before. What's actually happening now in the easing has not been particularly surprising because the outlook had been particularly soft, heading into these quarters, and that the emergence from the COVID zero or COVID policies was not going to be the boat that to lift all sectors. And I think the issue now, though, is that we don't have high global demand, or we have pressured global demand. So even though China is trying to provide some stimulus to provide a backstop, a support for domestic activity, the external sector is still very weak, and we're seeing that through the trade numbers as well. So in comparison to what we saw perhaps post 2008, 2009, global demand was buoyant because we didn't have the same level of interest rates. We in fact had liquidity being eased, and that's the very important swing variable that we're not getting right now.
If we look at valuations, Alex, in China, you were saying the US, well, on the one hand, they're stretched, but you think they could remain there. Is it almost the reverse in China, whereas actually they're very cheap? The MSCI China is trading about 10 times earnings, but could it stay there as well? Maybe it's just going to remain cheap.
I think it will remain cheap because China probably is the market which is least favorable to the AI theme, because I think the constraint of chips technology probably would still be there for quite some years, and the financial world actually advanced very fast. So you can imagine in 5 years' time, probably China would lag behind a lot in the AI theme. So that's why we are so low in valuation, and also I think other structural problems in the economy, like the populist sector and also the youth unemployment, are still a concern for investors. So I think the valuation will still remain low, and people probably would rather pay a premium for those high growth companies in other parts of the world. I think the global equity markets have been divided into East and the West, and the East actually is suffering because of the lack of AI concept.
When I hear you talk, Alex, about the markets, so much seems to depend upon AI. That really seems to be the driving theme that almost dictates now whether you should be in certain markets or not. Yeah,
because this is the largest things since the internet, I think. So and also this is in the every aspect of your daily life. So I think people probably would rather look into 5 to 10 years horizon and pay a premium on those companies which will survive in the new environment. So that's why I think China probably will underperform for quite some time. Actually, I think unless I think the Chinese government let people perceive the private sector would be the dominant force again, or the US probably would relieve some constraint on the chip export. Otherwise, I think China would continue to be cheap.
But there's no sign of either of those two things happening at the moment.
That two things actually are very difficult to happen. So if one thing happened, I think probably we will see we will shift value of 10 to 15%. But I don't think that will happen.
Okay. Patrick, what are your thoughts? Are you tempted by these valuations 10 times and, the bad news? Is it all priced in now?
Not tempted by the valuation, no. Look, I agree with Alex. I think, and one thing I see more particularly is I see the risk premium, has actually risen. So portfolio inflow to China is not happening because people are concerned about the stewardship. People are concerned about the track of the economy. So I think it remains cheap, and remains cheap on a relative value basis. For some time until some of these issues are resolved, and perhaps we need to wait until the presidential election next year to get some clarity.
And what about stimulus? People have been hoping for some stimulus from China, apart from these interest rate cuts, which have been fairly inconsequential. No sign really of any other form of stimulus coming at the moment, is there?
No, not really, and a little bit surprising how the markets reacted to that last week. Previously, when we've had signs of stimulus or interest rate cuts or additions to the economy, that has lifted all ships in the harbour, and we're not seeing that. So I think that people are perhaps were very cautious on the idea that the marginal value of this of these new projects or new stimulus is just not there.
There's one form of stimulus going on though that maybe the PBOC didn't deliberately intend, but the week yuan, that's acting as a form of stimulus, isn't it? It's at its lowest level now against the dollar since November. Could that help maybe sort of support export demand and provide some sort of stimulus to China?
I think it helps. Certainly, we need to remember that the dollar has been strong as well. There is a wide interest rate differential between the dollar and the yuan. I think, and as Alex pointed out earlier, potentially China will be exporting some deflation later in the year, but that will rely on global demand picking up. So I see the yuan remaining as an underperformer, in the near to medium term.
For me, I think the weak renminbi actually would be bad for the equities market in Hong Kong, because people probably would see the devaluation of certain utility sectors in Hong Kong, because the renminbi cash flow actually would be cheaper. So that, I think, would pressure those SOEs companies in Hong Kong. So that is bad. But for the economy, I think this is okay, because it would help to boost the export. But the point is, the customers actually trying to diversify their sourcing base already. So probably they are already facing competitions from places like India, Vietnam. I think that probably will not change. So the help may not be too much.
Well, let's turn to India. Now, Mark Mobius, he's the veteran sort of emerging market fund manager. He says India is the best place right now to park $1 million. He said, although he's still invested in China, he thinks India, the numbers in India tell a better story. He says the population is larger and younger. Its economy is growing faster than China's. He's not deterred by the Hindenburg report that targeted the Adani group company, because he said there's so many excellent companies in India, and he plans to boost his fund's holdings in India from 15% to around 20 or 25%. If we look at the performance, India's NSE Nifty 50 rose to all-time highs last week. The gauge is up 7.5% this quarter. Stocks in India, they've attracted an $8.7 billion in foreign inflows in March. That's the most in any quarter since the end of 2020. Also, rupee-denominated bonds are seeing huge amounts of overseas funds as well. So tell me a bit about India, Alex. What are your thoughts, first of all, on that?
Well, for me, I am not too familiar with the market, but I think the story is easy to tell. Like you said, the population is young and is growing, and also it would benefit from the manufacturing sectors and also the IT sector as well. So I think this is a very easy story to tell to the world, and the index actually performed quite good over the last few years. So I think inflows would still remain, and I think the Hindenburg report actually just dampened the bullishness, but the impact actually has been gone now. So probably we may continue to see the Indian market to perform well.
And does it fit in with the AI theme as well?
Yeah, I think that because India actually has been a very polarized society, so and they are quite advanced in certain techs and also medicine. So I think that probably would benefit from the new AI theme.
Patrick, what are your thoughts on India? Is this a market we should be paying more attention to?
Yeah, look, I agree. It's a simple story to tell. It was a good story to tell 10 years ago. It was a good story to tell 20 years ago. So there's been a few false starts there, without doubt. The currency we used to trade around in the 30s and now got in the 70s. So certainly it's become cheaper. I believe that it's doing well now for these clear reasons, and I think the story is easily out there. And perhaps likely to continue to outperform while the rest of the globe, is facing challenges. I think in a period where the globe is going more strongly, then I think India doesn't do quite so well. But I think in a period now where people are searching around for better yield and better returns and better prospects, I think India does certainly offer that.
Does it benefit from this sort of newly found or newly strengthened relationship with the US? We had Narendra Modi visiting Washington last week. Is there going to be some benefits from that?
Look, I think so. I think so in terms of investor sentiment. The ideas around the Chindia idea some time ago, was found to be not appropriate. China competing directly with India is not quite appropriate either. They're different types of economies. But certainly, as people are less encouraged or discouraged to invest in China, they do tend to group the country somewhat together, and India, Indian markets will gain some advantage from that.
Well, we're seeing quite a lot of tech investment there now, aren't we? Apple's announced more investment. Google, we've got Elon Musk saying he wants to invest in India as soon as possible. It seems that, global tech firms are waking up to India.
Yeah, because there's a populous nation, and also the young people actually are well educated. So I think that's why the tech companies actually found them quite suitable for investing. And also the local market, I think, would be attractive because probably we may see upgrades. Because recently we have quite good news from India. They have placed a very huge order for Airbus just recently. So I think the domestic market also will pick up, and we probably may see Apple to try to grab some market share from Xiaomi. So I think we probably may continue to see interest from those mega techs.
One final market I wanted to ask you both about, Japan. For the second quarter so far, the Nikkei 225 is Asia's best performing market. It's up 17% on the quarter. Year to date, it's up 25.6%. The last time the Nikkei traded at those levels was back in July 1990. Seems to be the real deal this time, doesn't it? There's been a few false starts in Japan over the years, over the decades, in fact. But this looks to be real now, doesn't it?
Yeah, look, absolutely real. The economy is doing well. The numbers that we see out of the economy, consistently rather, are beating expectations and doing well. The Bank of Japan has not yet had to start raising interest rates, so that's allowed the economy to breathe as well. That advantage or that spread has manifested obviously in a weaker yen against other major currencies. But it has also, underpinned domestic earnings of those companies, and the Nikkei doing well. And I expect that to continue while the rest of the globe, is facing some challenges. And I think Japan looks to continue outperforming. Notwithstanding, I think the yen will continue to remain weak.
And it looks like it's discovered shareholder value as well, doesn't it? There's much more corporate activism going on now.
At long last, yes.
I think, I think Japan will continue to perform, but the market actually is quite volatile. So last week we have seen a 1,000-point retreat in the Nikkei in one day after the CPI report. So probably we may continue to see that market to be that volatile. But I think it would go up in a volatile fashion. This is not like the U.S. market. Actually, the U.S. market is steadily up. But I think the Japan market actually would be quite volatile because I think people conviction is less. Probably they need some time to build up the conviction. And also the yen actually is a psychological factor to affect the market because we probably may see the market to correlate a lot with the forex in this market. So people would be a bit concerned as the yen is also already approaching 150 psychological level. So probably we may see the market to remain quite volatile because of this. So just be careful about that. I think one point is that we probably will need to be careful about those Japanese companies which are doing a business in China. So in the past, I think people are using them as proxy to play the consumer market in China because they probably would be better than those local companies. But I think Chinese actually are now less favorable for those Japanese brands. So probably we may see underperformance in those companies which rely more on the Chinese market.
And is the Bank of Japan, is that going to be a big factor in the second half? They sort of indicating, Governor Ueda, that they're going to stick with yield curve control, but then you get this inflation number, core inflation 4.3%, the highest since 1981.
Yeah, that's why we have seen a 1,000-point retreat on Friday, because that kind of concern would always be there. So I think that is would be the potential bearish factor, but other bullish factors actually would remain because, as you said, better corporate government performance, strong buyback from companies, and also the emergence of Japanese company in the global market. We are seeing more and more Japanese animes and also movies on Netflix these days, and I think that would help.
Patrick, final thoughts from you. The Bank of Japan, I mean, they've got a big part to play in this rally, haven't they? Is it sustainable for them to stick with ultra-low negative interest rates for much longer?
No, not for much longer. I think that they will move back from that in the next couple of quarters. I don't think it's going to be immediate. I think the yen can can regain some ground on that basis. But I think if you look at buying in at these levels, or it continues to be weak, and investing in the stock market, I think you're still going to outperform.
Well, thank you both very much for your thoughts. You heard there Patrick Bennett, Hong Kong-based macro strategist, and Alex Wong, who is the director of Alex K.Y. Wong Asset Management.
Peter Lewis's Money Talk.
I'm joined now by Yanan Wu, who is the chairman and CEO of Surfin Group, which is headquartered in Singapore. Good morning, Yanan.
Good morning, Peter. How are you this morning?
I'm very well, thank you. We're talking markets this morning. Let me ask you your thoughts on what really is the poor performance of Chinese stocks, both this quarter and year to date. Why is it that they're such a global underperformer?
Yes, indeed. The Chinese market, along with the mainland and also Hong Kong market, both show very disappointing performance so far this year. And especially when you consider the global capital market, the Nikkei index from Japan has made a new high since 1990s. Even Nasdaq, given the U.S. rate Fed hiking in the background, still make a 20% return so far, more than 20% this year. And both UK Fiji and France CAC also made new highs. Of course, India, you covered the topic last few days, and also pushed new highs. Even the market capitalization of India has also surpassed the UK and France market capitalization, become the fourth largest global market capitalization in the world. If it's even Russia and Ukraine stock market has made about 10 to 20% positive return so far this year. So really, Chinese market is compared to the rest of the world, whether it's developed market and developed market, both very suppressed. To say, I think there are mainly the three driving force that made both mainland Hong Kong market below expectation. Is really threefold below expectation. One is the macroeconomic in Chinese mainland economy so far as poor is below expectation. Secondary is their policy expectation. The policy, whether it's fiscal or monetary policy, the shows less support for the capital market. And thirdly is the market sentiment below expectation, especially look at the currency, the RMB, just over the Dragon Festival weekend so far has also, the offshore CNH versus US dollar has surpassed 7.2, this very critical level. So all three factors, economic, policy, and sentiment, all shows weaker expectation in China market.
Do you think any of those factors could improve in the second half of the year, whether it be the economic factors, or we get an improvement in the economic performance, maybe we get an improvement in the global performance? Any of those things could improve enough to really sort of cause a rebound in Chinese markets?
Yeah, of course. I think we all, as the market participants, all expect so. I think it's really depend on when's the turning point, and also where's the catalyst, for turning around this threefold expectation to more positive support for the market. When you look at the economic side, the PMI numbers, as we discussed before in our broadcast, it's both shows the main number shows a very weaker performance, whether it's manufacturing or non-manufacturing PMI, all showing slowing down. So the recovery speed or slope, if you will, is weaker than the market expected. So both shows from producer side and consumer side as contracted. So we have to wait until the PMI numbers shows more positive trend, and that won't take in one quarter. probably, at least 1 to 2 quarters to show PMI really turning around. So I think the second quarter will be challenging, for the market performance. So I think we still have to wait until the end of third quarter, or even the early first quarter to see the economic number turn around. Secondly, the policy measures, we can see all the bank rates have been reduced, whether it's LPR or the deposit rates, or start to compress and decrease. So that's a positive sign, but it's still below the market expectation, especially consider the fiscal stimulus is not ready yet. I think given the local government vehicle debt levels and also the fiscal level already reached a certain, the 3% limit. So I think fiscal stimulus still have to show more active support to the economic turnaround. So we'll have to wait until the political bureau meeting in July. So hopefully next month in political bureau meeting, we can see some more positive signs of policy stimulus coming up. And thirdly, of course, the sentiment. The RMB right now, given the geopolitical tension, even after Billiken, the Secretary of State Billiken visited Beijing, so the RMB still, depreciate during the festival, Dragon Boat Festival weekend. So that still shows a very weaker sentiment, especially global geopolitical tension, still worrisome to the market.
Investors have been waiting for fiscal stimulus now for quite a while, and they've been disappointed sort of time and again. They were hoping the other week that the State Council was going to announce something, but they didn't come up with any new policies. Why is it that the authorities are so reluctant now to come up with fiscal stimulus? Is it that maybe they're not so concerned anymore about economic growth? They're more worried about trying to reform the economy? What's the reason?
Yes, of course. I think how many tools in the toolbox is on the policy making side is remain to be seen. As I just mentioned, the monetary policies probably cannot do too much now because it's fixed. It has a dilemma. On one hand, trying to reduce the rate to push more money supply to the economy, but the last 2 years, the M2 has still maintain very high speed growth. 14 to 15%, about 40 trillion in the last 2 or 3 years. So, but still hasn't showed the CPI or PPI, turning positive in so far. So monetary policy isn't really had a limited impact so far. The real capital money doesn't go to the real economy is the concern. And for when you look at the consumer side, the June 18 is the e-commerce festival, and the GMV for the merchandise, consumption is only increased 5.4%. And, compared to last year. So really the consumer is not ready yet. They are more cautious to spend and consume. The May 1st Golden Week is also testing. The average per tourist, spending is only about 85 to 90% compared to pre-COVID level. So although more mobilization after relaxing the COVID policy, but the spending pattern hasn't reached yet. So I think the consumer side also is still wait to be seen. So stimulus is really have to wait until all the expectation can be changed. But so far the RMB is worrisome. Whether how much the depreciation can the central government accept is also a dilemma. For the fiscal side, the debt raised by local government funding vehicles has already soared to 66 trillion yuan, which is about half of China's annual GDP. So really the debt level is also a constraint for fiscal, even for the fiscal stimulus. So all these are constraints for policy stimulus.
And obviously all concerns for investors. One of the biggest groups of investors that have been selling heavily are foreign investors. And they've really been bailing out of Hong Kong and mainland stocks. I'm wondering, is that partly because now there is alternatives to China? You mentioned India, which is now one of the largest markets in the world. Japan, of course, is now performing as well. Are maybe other markets like India, like Japan, in Southeast Asia, markets like Indonesia, are they sucking money out of Japan and foreign investors are seeing other opportunities now that they didn't have maybe a year ago?
Yes, really, the money flow globally has a mixed signal. Japan has recently attracted, large institutional investors like Warren Buffett and other, institutions from the United States. So I think the Japan showing a more inflationary, sign than the deflation, that continued trend for the last 20 years. So that shows a positive sign for the global institutional investors. And so for both mainland Chinese market and Hong Kong market, it's really it's a job of attention that force some institutions are very cautious to re-enter the market. If you look at the liquidity of Asia market for the last 3 months, the last quarter, it's really so far the AI concept and also the SOE, Chinese characteristic valuation concept has sucked in the liquidity a lot. And the rest of the 78% of non-AI technology and non-Chinese characteristic valuation concept stocks has really only has decreased half of liquidity compared to last year. So I think the structure of Chinese Asia markets also is a bit too twisted, given the liquidity in the flow. So I think the globally we have to see institutions show more more confidence with the market sentiment change. So that has to show from the both economic and policy and also sentiment side to change.
Yanan, it's always a pleasure talking to you. Thank you very much for joining me this morning.
Thank you, Peter.
That's Dr. Yanan Wu, who is the chairman and CEO of Surfin Group. Thank you for listening to Money Talk this morning. You can find more details about some of the topics I've been talking about today, along with information on other headlines and market moves on my daily newsletter. Take a look at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Asian fund management industry consultant Stuart Aldcroft, Mark Toe, who is managing director of asset management at Wing Fung Financial Group, and our US economics correspondent, writer and broadcaster Barry Wood. Bye for now.
Money Talk